Welcome back to the Financial Shepherd podcast. My name is Joshua Casey Garland, certified financial planning professional, founder and CEO of Shepherd Wealth Management. Very excited to be back in home studios here today as we're about to wrap up the month of September. We got a lot of data today that we want to get through yet again. Going to provide, of course, some historical context to this data, what it really means, and some of our thoughts about that. So, welcome back to the Shepherd Wealth Management podcast. If you're a regular viewer and subscriber to the show, thank you for your viewership. Please like, share, and subscribe to Shepherd Wealth Management Podcast, your friends, family members, and coworkers. As usual, we're excited to be back in home studios today because not only is there a lot to talk about, but this is a pretty historically important time of the year. And I'm very excited to share the data with the audience. Of course, the Shepherd Wealth Management customers of ours have already received some of this data and some of this guidance. And if you're new to the Shepherd Wealth Management podcast, welcome. Please don't forget to hit that subscribe button so you're aware of every time we drop one of these podcasts every couple of weeks. You're going to get a lot out of today's show as usual. The main reason why Shepherd Wealth Management has had the success that we've had over the last 4.5 years, coming up on 5 years next year, as believe it or not, 165 plus million dollars that we're managing for our customers across 19 states and growing. Because some big announcements coming up next week. I don't want to get ahead of that for Shepherd Wealth Management. So very, very exciting news to share. So please check us out. Again, every 2 weeks, we're going to be dropping some of that pretty awesome news here pretty soon. And some of that is going to be on our website as well. So you can check out shepherdwm.com and find out all of that cool news, as well as background information about myself, our president and business partner, John Ashcroft, and the firm itself. So very, very excited to be here. As before we get into that, of course, some general news. Last time we did a podcast a couple weeks ago, my hometown Cincinnati Reds were about 6 games out of the wild card race for the Major League Baseball playoffs. Now they're 1 game back with 4 games to go, which is great news because my local Bengals here with Joe Burrow being out for 3 months, there wasn't a lot of things to get excited about. But we have an opportunity here to maybe squeak into the playoffs, so we're excited about that here locally.
We're excited about that here non-locally. We both share a fandom of Cincinnati professional sports. So, also being an LSU grad, the Burrow news was tough to take. I feel like that guy can't
Yeah.
catch a break. You're kind of wondering when he's going to be able to like string several years together to get his career going. But the
Yeah.
Reds is the
Yeah.
good news. We talked about a little bit before we started here how we're, 1 year, one season is not a data point and not a trend, but we feel like that they are in good hands and performing better than they have, even if they don't make the playoffs. They're in a good trajectory. Hope they can maintain it. So.
Absolutely excited. So we'll be watching that, and we'll see what happens this Sunday here. We're going to Mile High Stadium on Monday Night Football. Two teams desperately need a win. Right now, the Broncos are 1 win, 2 losses down. So if they lose the Bengals on Monday night at home, they'll be 1-3. And a lot of people had them picked as a sleeper pick for AFC championship type of stuff. So they'll be fighting to win. Obviously, the Bengals had the worst loss in franchise history last Sunday against the Minnesota Vikings. So hopefully they're going to turn that around. We'll watch. I just hope they play better. To be honest with you, it'd be great to win. But that was hard to watch last Sunday. So we'll see. All right. Getting back into the set program here today, and for those that are new to the program, why we've had so much success here for our customers, as well as the show as a whole, why we've gotten such great feedback from viewers across America, has everything to do with the fact that we look at the market through a lens of history. And why is that important? Well, the number one investor, or the best investor in my eyes, I think most people would agree. Warren Buffett said it the very best. The number one reason individual investors do not achieve the results they're looking for consistently over time is they do not have a process for controlling their emotions. He calls it temperament. So for us, how do we solve that major problem for our customers and for ourselves? Because I'm a human being as well. We've learned from behavioral finance that humans are hardwired with a lot of emotions, two of which are prominent in the investing world, and that is fear and greed. So we're all hardwired with those two emotions. Unfortunately, as human beings, we feel losses twice as much emotionally as we feel good about making a gain of almost any amount of money. So we are risk averse by nature as human beings. And the news does a really good job of placating towards mostly the fearful side of an individual. And the reason why that is because the news is a for profit business. They need viewership to sell ads. And they understand that you're going to be twice as engaged because you're twice, you feel those losses twice as much as you feel good about a gain. So if it's more of a fearful headline, you're generally going to be twice as engaged as you would be if it was a positive headline. And that's the reason why the news does what they do. But at this particular program, what we do is say, yeah, this is what's going on. This is what the news is talking about. And this is why it's important for you to be aware of it. However, what we do a great job of, which I view as the news dropping the ball on, is we say, hey, yeah, this is happening. But here's what the market looked like 6, 9, and 12 months later under very similar circumstances in the past. In other words, here's how other human beings have behaved in very similar circumstances. And what that does is two very powerful things. One, it should help you control your emotions because it puts the risk and reward based on the data of how other human beings have behaved in similar circumstances in the market's performance 6, 9, and 12 months later. And here are the sectors that make up the S&P. And here's how those specific sectors perform 6, 9, and 12 months later based on this data. It removes the emotion because it just puts risk and reward 6, 9, 12 months or longer out very clearly right in front of the investor. So it removes the emotional part. And once you have done that, now you can start to make strategic decisions in building investments or an asset allocation that fits your particular goals and risk tolerance, given the historical data of risk and reward under similar market circumstances that we're dealing with today. So that's what we coin as a process here for making consistently good investing decisions for our customers. And it's worked out great. I'm thankful to be able to share. Not only have we grown substantially, but year to date, the average customer here at Shepherd Wealth Management is up 30%. Net of fees, that's an average across all customer accounts. The market year to date's up 13%. And we've thankfully been able to navigate a lot of very bad headlines over the last 4.5 years. I mean, we've done a podcast throughout the entire time, so you can certainly go to YouTube and listen to any one of those over the course of the last 4.5 years. But just to rattle off a few, 2022 was the worst market year since 2008. That was our first full year in business. That was a terrible year to start a wealth management company. But we navigated through that and did well for our customers. 2023, everybody and their brother was calling for a recession of the worst magnitude. We looked at history and pointed to double digit returns. We crushed the market that year. 2024, all kinds of things happened. You know, you had the Fed engaged with raising rates and then starting a cutting cycle in front of a new presidential election. Obviously, a couple wars popped off during that period of time. I mean, we could list them all. We did a podcast across all of these different things. And not only is it successful for our customers here and now in the year to date conversation that I just had, but over the last 4.5 years, at minimum, the clients that have been with us for at least 3 of those years have at least tripled the performance of the S&P 500 net of fee. There's quite a few that have done much better than that. I say that not to pat ourselves on the back, although we're very proud of the performance we've been able to drive for our customers. What we're happy about the most is that the process that I've just described, at looking at the market through a lens of history, putting the risk and reward of those decisions clearly in front of you to remove emotion and make better, consistent decisions with your investments. That is a process that we believe is consistent, will work across all periods of time, because the one consistent thing about investing, specifically for the long term investor, the one through line across every moment time of history in the stock market, human beings are the people that drive the market up, down, and sideways. So if you can understand how other human beings have behaved in similar circumstances, it puts probability very clearly in front of you, and it helps you understand what the risk and reward is of every decision that you make. Now, it's no guarantee of immediate success or any guarantee of any success at all. Of course, investing involves risk, and past performance is no guarantee of future results. However, I think we could all agree that regardless of whatever it is that we're talking about, when it comes to the stock market history of performance, human beings haven't changed all that much in a couple of thousand years. And those are the individuals that will drive a market. And that's what we're going to dive into yet again here today. So let's get started with the news of the day here. As a whole bunch of macroeconomic data was dropped here this morning, and I want to kick that off here with home sales. Interest rates have been cut by the Federal Reserve just last week by 25 basis points. Home sales were expected to come in at 649,000 for the month of August. Came in at a whopping 800,000. So that's fantastic. Love to see that continue. Initial jobless claims also came in better than expected today. Economists were looking for 235,000 initial jobless claims ending September 20th. Came in at 218,000. So less initial jobless claims than expected is, in fact, a great thing. Most important data point of the morning. This is GDP. This is Q2 final GDP. So, of course, we gather data. Sometimes that data has to be, adjusted up or down. And this is the final reading for Q2 data. It was expected to be a solid, very solid 3.3%. The final number is revised upwards, 3.8% GDP for Q2, which is phenomenal. So full 2 percentage points, by the way, uh, above what the CBO scored, the big beautiful bill that was passed earlier this year. So that's what the US economists were using, 1.8% growth rate GDP for the US economy. And we're running at a 2% better clip than that, at least thus far. So certainly, there's been this debate of collecting data from the U.S. government and how accurate is it, and so on and so forth. I think that that's really good to exercise your brain and thought process of how can we do this better. I don't see any issue with that. But with the data that we got here today, is certainly very bullish, and it fits perfectly into the thesis that we've had all year long, that the policies, regardless how you may feel about them politically, they are very much in line with a growth type of economy and supportive of that. When the Fed cutting interest rates is lined up very nicely for our thesis here. So I'll have more to say about history and market expectations here in just a little bit. Tomorrow we got some very important data points tomorrow. This is going to come out at 8:30 in the morning. So we got a couple important pieces here. We got personal income, personal spending data points, but most important data point tomorrow morning at 8:30 is going to be the Fed's favorite measure of inflation, which is PCE, specifically the core PCE metric. And the street's looking for 0.2 month over month on the core PCE side. Year over year is going to be the tough part tomorrow. So anything month over month that's lower than what economists expect, obviously, is a good thing. Last year, this time, PCE was running at about 0.17, and economists tomorrow are looking for zero point 0.3. So it could be a slightly higher year over year figure, given that last year at this time, pretty low number there. But the month over month, I think, is going to be the main talking point for tomorrow's data. So be looking out for that as well. Now, Fed Chair Powell did have some comments yesterday, and it had nothing to do with the upcoming Fed meeting in October. It was really just a preset meeting, and he was given the microphone for a little bit to talk about, the economy and the future path of monetary policy. And here's what the headline is, and this is coming from CNBC. The headline reads, "quote," and this is as of today, September the 25th. And this was written by Ryan Ernie. Look, if I'm saying that right. But anyway, the headline is this: Federal Reserve's Jerome Powell warns that stocks are, quote, fairly highly valued, end quote. And here's what that means. So I'm gonna get to this quote here. So Federal Reserve Chairman Jerome Powell fielded questions about how central bankers factor market prices into their decision making. This is a terrible question, because this is something that they don't talk about, because they don't have an arbitrary price that they're looking for bonds, as an example. They're not looking for an arbitrary price point for stocks, or your house or anything else. However, this is the question that was posed, and for some reason, he decided to respond to it in this way. So Jerome said this, quote, "We do look at overall financial conditions. That's fine. That's the economy. not specifically the stock market. We do look at overall financial conditions and we ask ourselves whether our policies are affecting financial conditions in a way that is what we're trying to achieve, Powell said. He goes on to say, but you're right. By many measures, for example, equity prices are fairly highly valued. Powell doesn't just mean that stock prices are flirting with record highs. He means that stocks are looking overvalued, a sentiment that sent markets lower yesterday. Powell goes on to say, or I'm sorry, this is a quote from Sam Stovall, chief investment strategist at CFRA, in the same CNBC article. Quote, probably the oldest tenet in investing is buy low and sell high. What a dumbass thing to say. So this guy is a professional and he's like, hey, the strategy, a good one, a good old time strategy, just so you were, if you weren't aware, bring this to you. Let's buy low and sell high. I can't believe they quoted this in this article.
Call the Nobel Prize for economics. We need it right now.
Unbelievable. Um, and it goes on to say in this article, it's impossible. And this is the author writing this. It's impossible to know which quote measures Powell is looking at, but often when experts value stocks, they generally they look at price to earnings ratio. This is a popular valuation metric, also known as the PE ratio. Currently shows that stocks are indeed pricey. In fact, S&P 500 currently trades at a 41% premium above its 20-year average. So, how do PE ratios work? Just for those that might not be familiar, um, to determine how attractive a stock is priced, Wall Street analysts don't just look at the share price. Instead, they compare the price of one company's underlying fundamentals, such as sales, cash flow, or most popular earnings. And because investors reap the rewards of corporate profitability over time, they're willing to pay more than the company brings in order to own a piece of it in the form of stock. This amount is expressed by dividing the share price of a company's earnings per share to get the price to earnings ratio. For example, if a stock sells for $10 and is projected to realize $2 in earnings per share over the next 12 months, its price, $10 divided by its earnings, $2 would be 5. The PE ratio would be 5. Now, in a vacuum, this doesn't mean much, but it's a great way to compare one investment to another or to compare an asset or an index to its historical average. It's one metric, by the way, and this is getting off the article for just a second. It is a good metric. Of course, we look at price to earnings ratio here for our customers. It is one data point of many, though. Getting back to the article. Now, looking at the S&P 500 stocks in the index currently trade at 23.8 times their projected earnings over the next 12 months. That is true. Over the past 2 decades, the index has an average PE of 16.8. That means stocks are about 41% more expensive now than they have been over the past 20 years. Applying the same logic, you can say that the S&P PE high ratio means that US stocks are more expensive than international firms whose S&P indices trade at a price to earnings multiple of 15.7. You could also say that small cap companies such as the S&P small cap 600 index, which has a PE ratio of 17.1, trades at a discount to larger companies. None of that is to say that the S&P will go down tomorrow or up, or that foreign stocks or smaller companies will outperform over the next 12 months. And historically, the market operates in cycles with different asset classes taking turns in the proverbial lead. Now, price to earnings ratio, unfortunately, is very over discussed. And I think I mentioned this in a couple podcasts ago. It's like all these Wall Street people that they put on, CNBC or wherever you're getting your financial news of the day. It's like they all went to these Ivy League schools and these prestigious schools and et cetera, with these great job titles and decades of experience. It's like the only thing they remembered was the PE ratio, and that the S&P PE ratio is 16 over time. Like that's the average, which is true. But if that's the only thing that they're looking at to make any assessment of whether or not they should be buy, selling, or holding any specific stock or sector of the market, I think is foolish. and you have nowhere else to look other than the Mag 7. Because if you just looked at the price to earnings ratio and that was the only thing that you really weighted as the most important driver of buy, sell, or hold, well, you never really bought any of those, which means you missed out on some of the most historic market gains from those companies in the history of the stock market. And to think that those companies, those seven companies that we all know the name of, that coined the Mag 7, they are the very best companies at what they do in the world. So to say that they don't deserve some sort of premium for that, I think would be a very foolish thing for people to consider saying. Now, with all that being said, I do want to provide the audience here with rate cut probabilities. So we just had our first rate cut of the year in the September meeting. And as we go into the October meeting, which won't happen until the end of October, there's an 85.5% chance of another 25 basis point cut, with only a 14.5% chance of no cut whatsoever. And then December's meeting to wrap up the year currently, with all that news that just came out yesterday from Fed Chair Powell. And then, of course, we just got this morning's home sales, initial jobless claims, and GDP data. Tomorrow is very important with the PCE numbers, as I mentioned. But for December, and again, these probabilities can change with tomorrow's PCE data. But for December's meeting, there's about a 61.7% chance of yet again a third 25 basis point cut for the year. Um, so we'll see what happens. Obviously, like I said, these numbers can change very quickly, and tomorrow will be a big driver of moving these numbers either up or down, or potentially the same. So we'll keep an eye on that. I think the market is beginning to price in based on this data that just provided. October cut being over 85%, and December's cut being greater than 60%. We've called for that all year long. I've called for 3 rate cuts at 25 basis points a clip since the beginning of the year, and I've had a lot of people call us a little crazy for thinking that. Specifically, all the turmoil that happened at the beginning of the year with some of the biggest S&P 500 drops in S&P 500 history, and we covered all of that. I think that we've assessed the situation correctly. Even though the headline news in a silo throughout this entire year has been pretty damning. If you're an investor, and that's not my opinion, you can just simply go look at things like the AAII Net Bulls and Bears index, as I know that you enjoy so much in following that index. It's been negative all year long. It's been some of the most historically negative bearish sentiment by investors of all time. And there really isn't any hard data points that have supported any of those extreme decisions that investors have felt that they needed to make and sitting in money markets to the tune of over $7 trillion, which is far greater than the cash that we had on the sidelines in the worst stock market year of 2008, which was the worst since 1929's Great Depression year. Now, from a historical perspective, as I've mentioned, the Fed waited all year long this year and to their September meeting to cut interest rates. This has happened twice in the history of the market, 1998 and last year, 2024. Under both scenarios, historically, with the Fed waited all year to cut rates into their September meeting, markets finished the year higher between that September Fed meeting and the end of the year. So we do expect more new all-time highs for the market before we get to the end of December. And at the beginning of this year in 2025, in January, we always write, early January to all of our customers. Here's our expectations for the year. Here's why we feel that way. Of course, it's all based on historical data. And here's how we plan to meet those objectives. And of course, things will change and we might have to change our opinions too, which is why we communicate with our customers via a weekly blog that we write and post out to them through our mobile app every Friday. We do this podcast every 2 weeks and send that out to customers. I also write a monthly newsletter going over what happened the prior month, why, what does history have to say, and what our thoughts and what we're going to be doing on behalf of our customers every month. And then, of course, we sit down with them every single quarter. So when we do this podcast, we don't have any recommendations here at all for the general audience, only recommendations for our clients who we meet with regularly and have a ton of communication with and understand their situation well. So no recommendations here for the broader audience. And of course, any of the stocks that we talk about here today or otherwise, or any investment vehicle, whether it's an ETF or fund, etc., we don't get any kickbacks from any of these companies. So it's really truly just some data points and our thoughts about it. But going back to the historical data, two times in history, S&P, or I'm sorry, the Fed waited all year long to cut interest rates going into their September meeting. We believe that this is going to be more like 1998 than 2024. And I want to provide the investors with some data to help support that. So, 1998, when the Fed decided to cut interest rates in September, for the first time, September had a great month, which historically is not a great month for investors, but it was up 6.2%. We called that out in our prior podcast. Even more so, the best month of all 1998 was October. October was up 8% following that first Fed rate cut in September. November in 1998, after an 8% move in October, market S&P was up another 5.9% in November. And then in December of 1998, up again another 5.6%. So we're talking about potentially another 20%. Now, we're not calling for that here at Shepherd Wealth Management. That would be wonderful if that were to happen. But we are calling for a positive back half, or I'm sorry, back half, meaning Q4, October through December. Um, and if we're right, we should substantially outperform that as well with some of the moves that we've made here today, which I'm going to get to here in just a second. So 1998 is our comparison year here historically. We could have chose, 2024 as well. But the difference being that in 1988, the stock market lost 14.6% in the month of August, the month prior to, the Fed cutting rates for the first time in that September of 1998. Whereas 2024 was more of the opposite, kind of okay going into the Fed meeting and then a sell off afterwards. We think that we're going to continue to see, more and more all time highs here, which is why we believe this is more of a 1998 move as opposed to a 2024 move. Specifically, if we get two more cuts, actually from the Federal Reserve at 25 basis points a clip. And by the way, if the Fed decides to do a 50 basis point clip for all those out there that said, hey, we're not going to do three rate cuts, I'm counting that as two rate cuts. So, like I said all year long, 25 basis points. So, if they want to throw a 50 in there, to me, that's two cuts. So, for all of those folks that took the other side of our prediction of three rate cuts, I'm still counting that if they happen to squeak in a 50. Now, the other last point here, I know that we've already talked about it today, as with the U.S. economy, GDP, final Q2 coming in at a awesome 3.8%. Reuters definitely supports the excitement that I have, with their headline being the U.S. economy grows at the fastest pace in nearly 2 years in the second quarter at 3.8 percent GDP, which is again phenomenal. And if you compare that to history, the Fed is trying to sustain historically a 2% long-term GDP growth. And if they can do a little bit better than that over time, that's even better. So that's much better than what a lot of the economists at the Fed and other places have called for all year long. So if we can continue this growth trend, earnings estimates are continuing to grow. They have not come down. You have a Federal Reserve that is engaged in cutting interest rates. Unemployment is up a little bit, but it's certainly historically at what we would call full employment. But the Fed has shifted their gauge towards an eye on the jobs market as opposed to inflation, which is still why tomorrow's PCE data is very important. I want the Fed's mind to remain on the job market and less on inflation. We covered this in our last podcast, and inflation, from a lot of people's perspective, is starting to shift more towards what the administration from the White House has said all year long with their policy, is that if there is any inflation, most of that is going to be eaten by the companies themselves and will slowly over time be passed along, and is only a one-time increase in the price level. Last podcast, we talked about that, with some economists calling for only about a 0.4% drag, um, on the overall economy, and certainly not expecting massive inflation spikes, which is what the hysteria was from earlier days in 2025. So, with all that being said, with the Fed cutting rates, earnings estimates rising, and history on your side here, and by the way, the market's pricing in about another four cuts in 2026, and history would also support the second year of a presidential cycle being very strong. We'll have a lot more to say about the history of that as we get past the month of October into the last couple months of the year in preparation for 2026 and how we're going to help clients adjust their portfolios. So that is the macroeconomic data. History supports a lot of growth over the last quarter of the year here. So what are we doing? Well, what we prepared for prior to the Fed meeting is we took profits away from primarily the tech sector, and we allowed that to stay in cash for a period of days up until the Fed meeting, which just happened. And here we are this week, right before October 1, which is next Wednesday. History shows, again, as I described, October being the best month in all of 1998 when the Fed waited all year long to cut interest rates. We took profits, allowed the market to have this little minor consolidation moment. And today, just this morning, before we got on the podcast, we took, I'd say, about a third of that cash on average for our customers and put it to work, mostly in the same places where we took profits from a lot of tech names. We added more to some crypto with rate cuts, and crypto certainly being pulled back along with technology here today. Still expect good things. Rate cuts are definitely a big benefit for every risk asset in general. But on top of that, the Clarity Act is being kicked around in Congress right now, and I do expect a vote here in Q4. And I believe that the market is waiting for that true clarity, hence the name, the Clarity Act, so that banks can operate in this new crypto environment. And then I expect a lot of gains to happen from that. So we bought some tech names that we sold earlier prior to the Fed meeting, allowed the market to sell off to some extent. Didn't expect big sell offs, as we talked about in prior podcasts as well. There's just too much cash sitting around, too much liquidity, and way too bearish sentiment by individual investors that have missed out on an S&P 500 that's up 13% year to date. Can you imagine sitting on $7+ trillion, getting at best 4.2 ish percent in interest? And by the way, you have to keep that cash in there all year for 12 months to recognize that 4% interest, right? You get the market up 13. The difference between 13 and 4 is, I know you weren't a math major, is 9, right?
That seems
What's
like it's correct. Yeah, 9.
what would be 9% of $7 trillion? It's a big number, right? So just think about that. The reason why I say that is human beings make a market, they drive it up and down. They understand that they missed out on this 13%. It wasn't free. Investing always involves some level of risk. But if you were to just participate in the market and ignored all these headlines, you'd be 13% richer than you were at the beginning of the year. And you wouldn't even have had to hire and pay a professional like myself to achieve that. All you had to do was participate in it. So just knowing that and knowing that human beings have this emotion of missing out on gains, right? I expect these dips to be bought very quickly. And we were prepared for that. And we put, like I said, about a third of that cash to work this morning as the market was down on the S&P about 80 basis points. NASDAQ was down a little bit more than 1% at about the time that we pushed the buy button for our customers. And most of that has recovered already. So we're not the only ones looking at this historical data, it looks like, and making these decisions. We still have some cash to put to work. I wouldn't be surprised that tomorrow's year over year PCE headline is higher than what a lot of people might want to see by about 0.1%. I do expect the month over month number to probably be right in line. If it comes in a little lower, that could be a good day for the market. But the year over year number is almost as certain that it's going to be a tick higher by about 0.1%. That could cause enough rhetoric from places like CNBC and all these other financial news outlets to start to raise a lot of concerns and questions of, what does this mean for the growth environment that we're in right now? I could see a little bit more of a sell off to the tune of about 1%, probably nothing dramatic. But the point is based on this historical data, we want to be positioned in the sectors and stocks that we want for our customers based on this historical data right at the beginning of the month or real close to it. October 1st, October 2nd, that Wednesday, Thursday, somewhere around there, certainly by the end of next week, we want to have our clients positioned to take advantage of this historical precedent based on the S&P, or I'm sorry, the Federal Reserve waiting all year long into their September meeting before they cut interest rates. And those words from Jerome Powell regarding PE ratios of the S&P 500 and calling them quote overvalued, I have no idea why, as a professional in the most important financial seat in the US economy, would go there, because their job has nothing to do with providing commentary on the stock market or price levels or any of those things. But he decided to do that, and that caused the market sell off yesterday. These are the headline risks that I'm trying to help you manage through. Yes, that would be a fearful thing to see on a news headline that the Fed chairman says the stock market is over. Of course, he had to have known that that was going to be the reaction of the marketplace. Again, I don't know why he had anything to say about that because it doesn't have anything to do with his job whatsoever. But it did cause a sell off. It meant nothing. It didn't change the earnings expectations for corporate America. It didn't change a lot of things about the fundamental backdrop that we're in here right now. And any more of that selling that could come from headline news like that, that could happen between now and October. And why do you think that it was that October was the starting point both in 1998 and 2024, where the market really accelerated through the rest of the year as the Fed began a rate cut cycle? It wasn't just because of the Fed rate cut cycle. It also had to do with the fact that there really aren't any earnings going on in the month of September. And the last quarter of earnings beginning in October really doesn't happen until about the latter part of the second week in most calendar years. So, of course, as we've talked about in prior podcasts before, if there's nothing really going on to quote unquote worry about or get excited about, well, what the hell do you think is going to happen when you're at the news channel every day trying to drive eyeballs to your station or your podcast or whatever it is so you can sell ads and be a profitable entity? Well, they're generally going to bring some scarier topics to the table here, which is generally speaking why the month of September isn't that great. It also has to do with the fact that there's light volumes and people on vacation, all that sort of stuff that we've talked about as well. But when there isn't any news to talk about, the news still has a job to do with reporting news. And they're still trying to make a profit. So that's generally why you see that and typically see a lot of acceleration for growth after we get out of that malaise of no real corporate earnings data to speak of, and you actually get to earnings season again. So that's the historical backdrop that you're looking at. And when you do that, regardless of whatever headline may come up, unless it's just something like massive layoffs or something to that level, it'd be very difficult in my eyes to be this bearish that you're still seeing in these sentiment surveys. And as soon as that begins to change, here's the thing that I'd like you to keep in the back of your mind. And again, coming from Warren Buffett, Warren always talked about being greedy when others are fearful. We've been greedy all year long because investors have been extremely fearful, but it wasn't just because of that. We pointed a whole bunch of data point reasons, historic data point reasons, as to why we felt that way and why we took the actions that we did that led to the success that we've had here so far year to date. I think that once you start to see a lot of that cash move into the market, what you're also likely to see historically is as cash moves from sidelines to risk assets, where you generally start to see margin debt decline or increase, I should say, meaning that investors are getting so excited about the prospects of growth that they're willing to borrow from the brokerage company where they have their assets at. It could be a Fidelity, it could be a Schwab, it could be a lot of different places, but they're using the securities in their portfolio to borrow from Fidelity, as an example, or Schwab or whoever you're doing your business with, and they'll allow you to buy shares on margin. Of course, you're paying an interest rate to do that, and it's very, very risky and aggressive. And if you don't understand margin and what you're doing, I highly recommend that you stay away from it until you do, or talk to somebody like myself so you do have clear understanding of what the risk is that you're taking, because that'll definitely provide a boom or bust moment for you. So you definitely want to understand what you're doing there. But historically speaking, as investors feel more excited about the prospects of growth, not only does cash move from sidelines like money markets into risk assets like equities and crypto, um, but you generally see investors start to borrow on margin, and those margin numbers will increase. And that's the point in time where you start to want to take the opposite part of Warren Buffett's advice. He wants to be fearful as others get greedy. So I can definitely tell you that based on the historical data that we're talking about here and the current data of cash on the sidelines, investors are not feeling greedy right now. They're still feeling uncertain, based on any given headline that you might see in any one day. And certainly, the one thing that we can say is there is definitely a ton of headlines um, since the election, and I don't expect any of that to change over the remaining term of this administration. So headline risk is definitely going to be real. And if you're just looking at headline risk, if you're just looking at things like APE ratio, I think you're missing the broader picture here. And this is definitely the type of program that you're going to want to subscribe to. That way you get a different perspective, a broader, a historically based perspective to help you understand, am I being emotional or am I being rational based on data and history? And how other human beings that participate in the market, how have they behaved? Because to me, that is, again, really one of the only most predictable things that there is, when you talk about investing for the long term, is that the human being is just not changing all that much over thousands of years. So I can hang my hat on that, and that's why we're so proud of that process that we take and implement on behalf of our customers. It's not just the success it has; it's because it is a process that can be implemented consistently over time. And that's pretty much all we had to share here today, as we covered a lot of ground with data, macroeconomic data, some expectations based on historical data, what we've done for our clients to take advantage of that. And I guess to wrap it up is the sectors that I would encourage the audience to study and take a look at if they haven't participated in, or maybe they haven't participated in the weightings that they would want to. I think is still historically based. In Trump's first administration, um, the sectors that led the way were technology, industrials, financials, um, and certainly small caps played a role in that too. But those are the sectors that I would highly recommend that you take a consideration as part of the portfolio that you may or may not be building for yourself. And if you're still struggling with, I got all these gut feelings about this administration, their policies, and how they may impact things, or the Federal Reserve is going to make X, Y, or Z. This, if you're struggling with any one of those things, it's not your area of expertise, or maybe you're having a difficult time putting all the puzzle pieces that are constantly changing together to make clear decisions. This is what we're here for. Please give me a call, 513-630-2664. Check out shepherdwm.com. You can find all of our contact information. You can certainly leave your questions right here on YouTube. Love to interact with you and address those questions either one-on-one, or during the next podcast, which we should be delivering here in just a couple of weeks from today. So with that, is we'll wrap it up. Hope everybody has a great rest of their Thursday, and enjoy the remainder of your September before it's gone. Go Reds, and I hope you all have a great rest of your day. Take care.